a statement of cash flows, number one, that this is one of the components of the public financial statement. And number two, a statement of cash flows is generally prepared by a company for the company to show the sources of cash, how the company generated cash in a given financial year, and equally how that particular cash was utilized. So it means that once you're given a statement of cash flow prepared by a company, you should be able to see how the company was able to generate cash in a given financial year and how was that particular cash utilized by the company. On the other hand, when this statement of cash flows or a company is preparing a statement of cash flows, it should be prepared in accordance with the International Accounting Standard number 7. So it means that IAS 7 prescribes how a statement of cash flow should be prepared, should be presented by companies at the end of the the year. And also, when a statement of cash flows is being prepared here, according to this particular standard, the various activities undertaken by a company should be classified into three. All the activities undertaken by the company should be classified into three activities. Number one, we have the operating activities. Number two, we have the investing activities. And number three, we have the financing activities. So first of all, what do you mean by the operating activities? The operating activities are the revenue generating activities undertaken by a company. In other terms, we can say that these are activities which the company undertook in a certain, or basically in a certain financial year to generate revenue. So these are activities undertaken by a company to generate revenue. And good examples of the activities which the company undertake to generate revenue, they include providing services. We also have a sale of goods and so on. So those are basically revenue generating activities undertaken by companies. Then from there, we talk about the investing activities. These are those particular activities which involve the sale or the disposal of assets, and also acquisition of assets. Acquisition of what? Of assets. So mean that when we talk about the investing activities, these are those particular activities which involve acquiring assets and also disposing assets. In this case, when we talk about the asset here, we are talking of we are referring to the property, plant, and equipment. Property, plant, and equipment, if you can be able to recall from the previous topic, we know that these are tangible and current assets. Assets such as motor vehicle, plant and machinery, maybe property, and so on. So also, we are referring to intangible assets here, or basically assets also include the intangible assets. They also include things like investment and so on. So therefore, any activity which involve acquiring and also disposing or selling assets, all those particular activities are investing activities. On the other hand, we talk about the financing activities. These are the activities by the company which by the end of the day affect the size and composition, size and composition of a company's capital structure, So meaning that any activity which the company undertakes, and by the end of the day, it affects the capital structure of the company, then it is a financing activity. Good examples of financing activities include activities such as issue of shares, issue of debentures, issue of bonds, acquiring bank loan, a repayment of bank loan, redemption of debentures. All those are good examples of what are known as the investing activities, financing activities, simply because those particular activities, by the end of the day, they affect the size and composition of the company's capital structure. So therefore, according to the International Accounting Standard number 7, whenever a company is preparing a statement of cash flows, then the various activities undertaken by the company in a given financial year then should be classified into three: operating, investing, and financing. And then the company should proceed and determine something called the net cash flows from each of these three activities. Now, how do we determine these net cash flows from operating, investing, and financing? So to determine the net cash flows, we take the cash inflows. When we talk about the cash inflows, this is basically any cash received by the company. For example, if the company sells an asset, it is obvious that the company will receive cash. So or money will be received. That is a cash inflow. It is money which is flowing into the business. And the rule is that when preparing the statement of cash flows, any amount which is a cash inflow, we record it in the statement of cash flow as a positive. Any amount which is a cash inflow, we record it as a positive, and then out to this we less the cash outflows. Cash outflows, any cash which is moving out of the business, and any cash outflow, when being recorded in the statement of cash flows, we record it as a negative. For example, the company has acquired some assets, so basically, which means that there is a cash outflow. We record it in the statement of cash flows here. We record it in the statement of cash flows here as what? As a negative. So therefore, we take the cash inflows, which are positive, minus cash outflows, and then we get now the net cash flows from these three activities, from those three activities. Now, before we move and look on how we present, or in other terms, we prepare a statement of cash flows. First of all, I want us to look on a definition of various terms. Basically, these are terms you're going to come across in the preparation of the statement of cash flows. So the first term here is cash. And in this case, when we talk about the cash, basically we're referring to the cash in hand. We're also referring to the cash at bank, cash at bank. We're also referring to the bank overdraft, that is the bank OD, and also what we refer to as the demand deposits, the demand deposit. So when we talk about the demand deposit, usually this is any form of all money which is held in a fixed deposit account. If you have maybe some savings in a fixed deposit account, that is known as a demand deposit. So therefore, cash comprises of all this: cash in hand, cash at bank, including bank overdraft, and the demand deposit. The other term is something called the cash equivalent. Cash equivalent. Cash equivalent, this refers to the short-term investment which can be converted into known amount of cash within a short period of time. So short-term investment, investment, and we are saying that this particular short-term investment can be converted into known amount of cash within a short period of time. A good example of this is, for example, investment in shares which are trading in the securities exchange market. So if you have invested in shares, they are trading in the securities exchange market. If you need some cash urgently, what you just do is you instruct your stockbroker to go ahead and sell those shares. And within a number of days, within like 3 or 4 working days, you'll be having money in your account. So that short-term investment itself is not cash, but we say is an equivalent of cash. Is a cash equivalent. Is an investment, a short-term investment, you can be able to convert into a cash within a short period of time. So the other term we also need to define here is something called the non-cash items. Non-cash items. So the non-cash items, these are items of incomes and expenses. These are items of incomes and expenses which do not involve cash inflow or cash outflow. They do not involve a cash inflow or cash what? Or cash outflow. So in other terms, these are those items which a company will account for as expenses or basically incomes, but they do not give rise to cash outflow or cash what? Inflow. What are good examples of these items here? Good examples include things like depreciation. Depreciation, we know that this one is accounted for as an expense, but does depreciation give rise to cash outflow? No, because depreciation, this is the estimated loss of money value of what? Of asset. Depreciation is not the same with salary. Is not same with the rent. We know salary rent are accounted for as an expense, but once the company pays salary or rent, that gives rise to cash outflow. Depreciation is accounted for as an expense, but does it give rise to cash outflow? No. Another good example of a non-cash item is something like impairment loss. Impairment loss, this is the decrease in value or the loss of value of goodwill. So if the goodwill, which is basically an asset, its value reduces, then we refer to that as impairment loss. And also we have amortization of intangible asset. Amortization of intangible asset basically refers to the amount of intangible assets which was written off during the current year. That is basically equivalent to depreciation, is accounted for as an expense, but it basically does not give rise to what? It does not give rise to cash outflow. And therefore, the rule is that anytime you're preparing or presenting a statement of cash flows, you only take into account those transactions by the company which involve cash inflow or which involve cash outflow. So if the company took a certain transaction, or maybe there was yes, undertook a certain transaction which does not involve cash inflow or cash outflow, you don't consider it in preparation of the statement of cash flow. For instance, if you're told the company made a bonus issue, we know these are shares issued to the existing shareholders of the company free of charge. Do they give rise to cash inflow? Does the company receive any money from the shareholders as a result of making the bonus issue? No. So therefore, such a transaction, which is a non-cash item, we don't consider it. We don't take it into account in preparation of the statement of a cash flow. So we only take into account those transactions which give rise or which resulted to cash inflow or cash outflow. So these are basically some of the terms you need to know. You need to know because you're going to come across most of those particular terms in preparation of the statement of cash flow. So next, I want us to look on how a statement of cash flows is presented or is basically prepared. So presentation, or actually we can talk of preparation of statement of cash flows. Statement of cash flows. Now here we have two methods which may be used to prepare statement of cash flows, or in other terms, to present a statement of cash flows. Two methods. The first method is called the direct method. And number two, we have the indirect method. So these are the two methods which may be used by a company in preparing a statement of cash flows. Now, before we discuss these two methods of or we look on how we prepare the statement of cash flows using these two methods. The first thing you have to recall is that when a company is preparing a statement of cash flows, a company should determine the net cash flows from three activities. That is something already we have mentioned. The company should determine the net cash flows from operating activities, number two, investing activities, and number three, from financing activities. And therefore, the difference between these two methods of preparing a statement of cash flows, the direct indirect method, is how to determine the net cash flows from operating activities. That is the only difference which exists between direct and indirect method, meaning that under the two methods, direct and indirect method, in terms of how we compute the net cash flows from investing activities and also financing activities, we use the same approach. We use the same approach. And therefore, I want us to start with the direct method. And specifically, we look on how we determine cash flows from operating activities using this method here. Now, under the direct method, as the name suggests, to determine, or in other terms, to compute the cash flows from operating activities, we compute this directly from the cash book by taking a number of items here. So first of all, we can say that the net cash flows from operating activities is determined directly from the cash book. Is determined directly from the cash book. So basically, we know what we record in the cash book. In the cash book, a company records money which was received, and or basically the receipt of money and the payment of, or the payments which were made. And therefore, to compute this one, that is the cash flows from operating activities. Using now the direct method. We go to the cash book prepared by the company and we take a number of items. One, we take the cash received from debtors through customers. Cash received from debtors through customers, of which this cash received from debtors or customers, this one is automatically an inflow. If you have a business and you have received money from your customers, from your debtors, what does that mean? It is a cash inflow. And you have to recall what you have said. When preparing a statement of cash flows, any amount which is a cash inflow, we record it as a positive. Any amount which is a cash outflow, or which involve outflow of cash, or which is an outflow generally, we record it as a negative. So therefore, cash received from debtors or customers automatically is a cash inflow, recorded as a positive. So number two, we also go back to the cash book and we take into account the cash paid or basically the cash paid, first of all, to the suppliers through creditors. And the cash paid to suppliers or creditors, this is a cash outflow. Being a cash outflow, we record it as a negative. So also from the cash book, we take the cash paid for operating expenses. Operating expenses. The cash paid for operating expenses is also involve cash what? Cash outflow. Then we get the net amount here, and then we proceed and we less two items. One, we less the tax paid. We less the tax paid here. Tax paid, the reason why we are raising that is because once the company has paid tax, we know that tax is paid from the cash, which will be generated from operation. So tax paid is a cash outflow. That's why we are raising it there as a cash outflow. And then also here we less the interest, or in other terms, the finance cost which was paid. So if the company paid some finance cost or some interest, which is also paid from the cash generated from operation, that involves cash outflow. And then what do we get here? We get the net cash flows. The net cash flows from operating activities. The net cash flows from operating activities. Net cash flows from operating what? Activities. So that's basically how we determine the net cash flows from operating activities using now the first method here, which is the direct method. So definitely after getting this particular net cash flows from operating activities, we then proceed and determine the net cash flows from investing activities and then from financing activities. But before we do that, before we look on how to determine the net cash flow from investing and financing, what I want us first of all we do here is we look on how we determine the same. We look on how we determine the net cash flows from operating activities using the other method, which is the indirect method, because you have said the only difference which exists between direct and indirect method is how we determine this. So therefore, what I want us to do is that we look on how we determine, or in other terms, we compute the net cash flow from operating activities using now the indirect method. Using indirect method. So let's do that. Number 2, we have indirect method. Indirect method. Now, under this particular method here, to compute the net cash flow from operating activities, we do that by adjusting the profit before interest and tax, or the operating profit, with a number of items. So meaning that net cash flows from operating activities is determined by adjusting profit before interest and tax. This profit before interest and tax, this one is also known as operating profit with the following items. So we adjust this profit with a number of items. One, we adjust this profit with the non-cash items, which were added or deducted in arriving at this profit. Added or deducted in arriving at this what? A profit. Remember, you have said non-cash items. These are items of incomes, or the items of incomes, or the items of incomes, or items of incomes, all expenses, which were used in the computation of this particular profit, which do not involve cash inflow or cash what? Outflow. In this case, we have a number of items here, and actually there is this acronym which is used by majority of the students in terms of remembering some of those non-cash items. The acronym is 𝗙𝗪𝗔. 𝗙𝗪𝗔, this is an acronym. D stands for depreciation. A, this one stands for impairment loss on goodwill. A stands for amortization of intangible assets. L stands for loss on disposal, and A stands for gain on disposal. So any non-cash item which was deducted in arriving at this particular profit, you add it back. Any non-cash item which was added in arriving at this particular profit, you do what? You less it. So number 2, we also adjust this particular profit here with the changes in working capital. And here we consider 3 items. Equally, there is that acronym which you can be able to use to remember the 3 items of working capital which we consider here. R stands for receivables, I stand for inventory, and then payables. That is P stand for what? For payables. So as far as those 3 items are concerned, you just need to analyze them. You compare the opening balance with the closing balance, and actually you determine that increase or decrease by comparing the opening and closing balance. That increase or decrease, was it a cash inflow or cash outflow? And then finally, we also adjust our profit here with investing, or that is investing and financing activity items which were equally added or deducted in arriving at this profit. Any investing or financing activity item added or deducted in arriving at this what? A profit. A good example of this is something like investment income. Investment income, we know when preparing the income statement or when computing this profit, we treat it as an expense. Sorry, not as an expense, we treat this as part of the other incomes. And basically, we add it to the gross profit. But now we know that investment income, this is an income generated by the company, but not from operating activities. This is an income the company generated because it has made a number of investments. So remember, we want to know how much cash was generated from operating activities. And because this investment income is already included in this particular profit, and it is not an income generated from operating activities, what we do, we less it. We less it from our profit simply because it is not a cash generated from operating activities. And then once we have deducted it from the profit, we will consider it when computing the cash flows from investing activities, because this money generated from investing what? Activities. So therefore, here we compute now the net cash flow from operating activities by adjusting this profit with these categories of what? Of items. And therefore, here we can look on the format of determining the cash flows from operating activities. Operating activities using now the indirect method. Using the indirect method here. So always when preparing a statement of cash flows, we have two columns here. And we always have two columns here. So always we start with the, remember I said we start with the profit before interest and tax, or the operating profit. But in most of the questions, the examiner will not have given you this particular profit. The profit which will be given by the examiner is something called the profit before tax. And therefore, what you do, you start with that profit there, the profit before tax. And then you make a number of adjustments to this profit. This profit, you adjust it with a number of items. And the first adjustment you should make to this profit is to add the finance cost, or basically to add the interest expense for that year. You add interest. So why are you adding interest there? As the first adjustment is for you to have the profit before interest and tax. Once you have added these two figures there, you will have profit before interest and tax, because essentially that's what you had to start with here. But because that profit was not given, we are saying start with the profit given, that is profit before tax. And then the first adjustment should be to add back the interest such that you have the profit before interest and tax. Then proceed and adjust that profit with a number of items, starting with the non-cash items. For non-cash items, you just use this acronym here. It will help you in terms of remembering a number of items. So D here stands for depreciation. So this is depreciation on PP. I stand for impairment loss. Impairment loss, this is the decrease in value or the loss of value of goodwill. Then we have A, which stands for amortization. This is for intangible assets. Amortization of intangible assets, this refers to the value for the intangible asset which was written off during the current year. And then we have L, which stands for loss on disposal. There were some assets which were disposed during the current year and they were disposed at a loss. And then this here stands for gain on disposal. The loss, this one should be loss on disposal. And then this one should be gain on disposal. Now, the first four items here, depreciation, impairment, amortization, and the loss, all these items, in arriving at that profit, they will have been deducted because they are expenses. And therefore, what you do, all these, the first four items, you add them. You add them to the profit here because they were deducted, but they do not involve cash outflow. Add them back because we want to know how much cash did the company generated from the operation. So we take the profit and then we have to add back any expense which was deducted, which does not give rise to cash what? Outflow. And then for the gain on this disposal, this one is actually accounted for as an income. In arriving at that profit, that one will have been added. And because it does not give rise to cash inflow, what you do, you less it there. So those are basically some of the non-cash items, which now we adjust to the profit. And then from there, we get something called the changes or the cash flow before changes in working capital. And I think before we do that, there are also other items which we adjust to that particular profit, including investment income. Investment income, remember, we have said in arriving at that profit, it will have been added, but basically we know that this one is not an income, from operating activities. So you less it there, and then when computing the cash flow from investing activities, that's when we consider this. And then whatever we get, the net amount we get there, we refer to that as cash flows before changes in working capital. Before changes in working capital. That is the cash flow before changes in working capital. And then from there you proceed and you consider changes in working capital. You consider changes in working capital. Remember, we have said that for the working capital here, we consider 3 items, and I think I've given you the acronym here to help you to remember the 3 items of working capital which we consider here. The acronym is RIP. Here we consider receivables, inventory, and then payables. Because what you need to know is that when we talk about the working capital is equal to current assets minus current liabilities. Current asset minus current liabilities. But we only consider 3 items of working capital: receivable, inventory, and payables. And what you do, you take the opening balance minus closing balance, opening balance minus closing balance, opening balance minus closing balance. You determine was there increase or decrease as far as these items are concerned. So here the increase or decrease would be a cash inflow or a cash outflow. I'll show you how to determine whether this is a cash inflow or cash outflow. Yes, and then we get the net amount down here. Then we proceed with less 2 items. We less 2 items. 1, we less the tax which was paid by the company, and number 2, you less the interest on the finance cost which was paid. And actually, I've said that the reason why we less these 2 items is because they are cash outflows. These involve cash outflows. These involve cash outflow. So then from there now we get what is known as the net cash flows from operating activities. We get net cash flows from operating activities. So that's basically how we determine the net cash flow from operating activities using now the indirect method. But if you use the direct method, or actually you use direct method, another person prepare the statement of cash flows using a direct method, by the end of the day, you should get the same value. The same value. It's only that you're using a different approach to compute the cash flow from operating activities. So if you use direct or indirect method, by the end of the day, you should get the same value now. So that is the only difference between direct and indirect method. How to determine this. Now, what I've said is that once you have determined this net cash flow from operating activities, you proceed and determine this one. Net cash flow from investing, net cash flow from financing. And I've said under the 2 methods, direct and indirect method, we don't have any difference. So therefore, let's look on how we determine the cash flows from investing activities. So you have to recall that when we talk about the investing activities, these are those particular activities which involve acquisition, acquiring assets, and disposing assets. So therefore, what we consider here, 1, are the assets which were acquired during the current year, acquisition of assets, of which asset acquired, whenever the company acquires asset, that we know it involves cash outflow. So record that here as a negative. Reason being, this amount is a cash outflow. We also consider assets which were disposal or sale of assets. And whenever when the company sell an asset, what we consider here is the proceeds. So that asset was sold at an amount of how much, which we include here as a cash inflow. The moment the company sell an asset, the company receives cash. So, and then here we also consider the investment income received. Any investment income received, we also consider it here as a cash inflow. And the reason why we consider that is because this is cash, or this is yes, this is cash generated, or this is an income generated from investing activities. investing what? Activities. Finally, we determine the cash flow from the financing activities. From financing activities. And actually recall, we say that these are those particular activities by the end of the day which affect the size and composition of the company's capital structure. And therefore, all the items now which we include here, we get them from equity, equity, and non-current liability section. A non-current liability section of the statement of financial position. Of the statement of financial position. And therefore, some of the items which we include here, number one, we have issue of ordinary shares. Issue of ordinary shares, issue of things like debentures, and so on. So once the company has issued debentures, has issued shares, the company receives cash. Record that amount there as a cash inflow. So we also consider things like the dividends paid. If there are some dividends which were paid, that is still considered as an investing activity. And payment of dividends, we know it involves cash outflow. Record that here as a negative. So the other thing which we also consider here are things like the bank loan, which were acquired. The company acquired a bank loan during the current year. If yes, record it there, which is basically a cash inflow. Was there a bank loan which was repaid, or was there a repayment of a bank loan? Bank loan repayment. A repayment of bank loan basically involve cash what? Cash outflow. Involve cash outflow. So record it there. Yes. So those are basically some of the items which we consider. Get the net amount. And then once you have gotten the net amount here, you proceed and you determine something called the net changes. The net changes in cash and cash equivalent. You determine something called the net changes in cash and cash equivalent. So how do you determine this one? To determine that, we add three items here. One, we add the net cash flow from operating, the net cash flow from investing, the net cash flow from financing activities. We add these three figures here. Whatever we get is known as the net changes in cash and cash what? Equivalent. Now, to these net changes in cash and cash equivalent, we add something called the cash and cash equivalent at the start of the year. So to this one, we add cash and cash equivalent. So C is cash equivalent like that in full. So this cash equivalents, balance brought down. And in this case, you have to recall we have defined what is cash. Cash, we have said this comprises of cash in hand, cash at bank overdraft plus demand deposits. Whereas now the cash equivalent, this comprises of any short-term investment, which can be converted into known amount of cash within a short period of time. So after adding this to that, then we get something called the cash and cash equivalents balance carried what? Balance carried down. Balance carried what? Carried down. Yes. So that's basically how we present or how we prepare the statement of cash flows. Remember, in this case, you have said that we have two methods of preparing a statement of cash flows: the direct method, indirect method. But in this case, I've said that the only difference which exists between the two methods is how to determine these net cash flows. These net cash flows from operating what? Activity. So mean that there are the two methods, direct, indirect method. To determine the cash flow from investing, cash flow from financing activities, we determine that using the same approach.